My next guest is here to warn investors that the Fed is going to have to hike until it hurts. What does he mean by that? Let's bring in Ethan Harris. He was the first Wall Street economist to forecast this aggressive tightening from the Fed. Ethan, it's great to have you back today. Explain.
Well, I mean, the problem is that the Fed started the hiking cycle a little too late. And as a result, you've got a labor market that's not just hot, it's record hot. And it's not going to slow down anytime soon. So by the time we get to, say, the end of this year, we're probably looking at an unemployment rate of only 3% with many other indicators of labor market tightness. That's too much to keep inflation under control. So the Fed's probably going to need to slow the economy down enough to really cool off the labor market. And so that's why I say they have to hike until it hurts. And depending on how serious the inflation problem is going into next year, is it running at 3% or 4% or whatever, that will determine how painful this is.
I don't know if you caught our panel at the top of the hour, but if I had to summarize in a nutshell, I'd say their concern is the Fed is they made a mistake by being too dovish at the start, and now they're going to make a mistake by being too hawkish during this phase. What would your response to that be?
I don't agree. I mean, they definitely made a mistake by waiting too long. I think the case for rate hikes was already there back in October when you saw inflation starting to spread out broadly in the economy, and it became clear that the labor market was going to seriously overheat. So they waited about 6 months too long. But you don't fix that mistake by not being tough now. They have to push the economy into a weakened state if they're going to be serious about fighting inflation. If you go back to the history of serious inflation problems in the U.S., this is what the Fed did in the 1970s. They didn't get inflation under control early in the process. They let it keep coming back and back and back until you finally had to get Volcker to come in and absolutely hammer the economy. That's not the right way to do things. You want to nip it in the bud, and they need to do that in the next year or two.
The Doves say that food and energy prices are not caused by excess demand. In other words, if the Fed is trying to ameliorate those price hikes, they're using the wrong tool to fix the wrong problem.
Yeah, I mean, the Fed's had some bad luck here, and some of the price inflation is definitely out of their control. I mean, they don't control commodity markets, they don't control the food market. What they do control is whether you have a seriously overheating labor market and whether you have broad inflation that's affecting other parts of the economy. And if you look at the data right now, inflation for the typical product, forget about used cars and gasoline, all that stuff, the typical inflation rate in the economy right now is 3 or 4%. And that's just too high. That is the Fed's responsibility. It's not their job to get food and energy prices down. It's the kind of middle of the distribution, the typical price increase that's been let out, the genie's come out of the bottle.
Do they have a communication problem, Ethan? Because it strikes me that the success you're describing in fighting inflation is going to look like failure to a public who might be experiencing recession at that point.
Yeah, I think that they don't have easy choices now. I have a lot of sympathy for the Fed. I wish they'd started earlier, but now the choices are pretty stark. Unfortunately, I think that there's still one step in the messaging out of the Fed. Right now they're saying we think we can normalize without hurting the economy. That seems mighty optimistic to me. I don't see how that can be true. I think they need to come clean at some point and say, listen, we're not trying to kill the economy, but we need to reverse some of this overheating. And so we need to go through a period of very low growth. And yes, we could get a recession. That's an honest appraisal of where we are right now.
Or maybe to clarify the primary target, which is inflation, to say we are going to hit X% no matter what the fallout is.
Yeah, and to understand the public to understand the lessons of history, which I talked about earlier, that you want to get inflation early, not late. It's much easier to get it down. You can do it with a modest slowing in the economy or a very mild recession if you do it early. If you wait until what the Fed did in the 1970s with Volcker in 1979 to 1982, you end up just killing the economy in the process. They had to raise the funds rate to 20% by then. So you definitely don't want to go down that path. So let's get a little bit of it's kind of like a little bit of medicine now is prevention's the better than cure. So let's do take a little bit of medicine now, so we don't have to do an even tougher battle, 3, 4, 5, 10 years from now.
Well, I think this was a perfect curtain raiser for this decision and for the press conference. Ethan, thanks for your time.